Hello, I'm Mariana Danilovich with Ultralive TV, and here we are at Digital Hollywood Fall 2010 with Megan Jones from Hadley Partners, which is an investment bank.
It's an investment bank, and I work mostly with digital media companies.
And do you do corporate finance, investment banking, private equity?
Mostly it's investment banking, and so what we do is we do capital raises, raise money for companies, and then we also help companies sell themselves or buy other companies.
Okay, so you do an M&A as well.
Yeah.
And so what level of funding, stage of funding are these companies?
They're pretty much, we call it institutional stage. It's when the company is already cash flow positive, they've got a certain level of revenues, customers in place, and they've usually, but not always, raised venture funds before. And they're looking, it used to be considered the last round of funding before you went public, but since a lot of these companies aren't going public anymore, it's kind of the last fundraising before you're so cash flow positive you don't need to raise much money anymore.
And if they're cash flow positive, you basically take your fees, but the investors, how do they just get a return from a company like that without an exit?
That is one of the issues of the panel that I'm on. I'm on a panel at 2:15 on Wednesday, and we're going to be talking about exit strategies. Interestingly enough, I have a blog at Hadley Partners if you go to the website, and one of the recent postings was reprinted on SoCal Tech, and we've been having some debates back and forth online with respect to exit strategies. Because the reality is, if you sell a part of your company, at some point your investors are most likely to want an exit strategy. There are a few very wealthy people or private equity funds that will stay involved in a company just based on a dividend that you're getting paid, or a certain, it's usually from debt, but a certain kind of payment that you're getting periodically. But most of them at some point really do need an exit strategy.
And so, in essence, even though there's not an IPO, the founder of a company that's taking maybe a Series C or a D round has to think about sale or partial sale.
Absolutely, and this is another point that I've made before repeatedly, both to clients, online to blogs, and in panels, which is not everybody should take money. Once you sell part of the equity in your company, you are no longer the sole owner, and you need to kind of build the company based on that expectation that some of those investors may need to get that. It's not that they even want the money back. Sometimes their funds themselves need to get that money back at a certain point.
So there haven't been too many hockey stick growth companies that have had successful exits perhaps in the last year or so?
I think the IPO market is okay. It's better than it was, but it still isn't great. On the M&A front, though, there have been a number of companies that have done fabulously well. The companies that I work with, you have media buyers very often, but you also have technology buyers. And so some of the more innovative, acquisitive companies like Cisco or Google are sitting on huge cash piles. And they've been buying companies very often at rich valuations. And also they're preemptively coming in and making bids. So I've met with a number of companies that are very high growth, younger stage companies that have gotten bids, but they're not for sale. So in most cases they've turned them down, but they did have that option to sell at very early stages. Sometimes pre-revenue, but usually once they've already started monetizing.
So these bids pre-revenue for an early stage company that hasn't been around for maybe couple years or so, what ranges of valuations are we seeing?
That is a very tricky question. A lot of them aren't being disclosed because, for example, in Google I got an article the other day which said that Google has done 3 times, or they said like 23 acquisitions this year, and Apple had done none, or Microsoft had done none. But if you looked at the actual numbers, Microsoft has done 8. They just haven't disclosed any of them. So you have to really follow the blogs very carefully to find the acquisitions. But the valuations can range from $10 million to $100+ million, just depending on the stage of the company.
And these are pre-revenue?
At $10 million, they're usually pre-revenue, but they've either got a core technology or a management team that has kind of the right expertise that the acquirer wants, or in some way they're changing an existing product, application, service that the acquirer already has in a material way. But for a pre-revenue company, you're not going to get $100 million ever.
What is the most you've seen for pre-revenue?
For pre-revenue, probably the most I personally have seen is $10 million. But like I said, a lot of it's not getting disclosed. And quite honestly, if Microsoft comes in and offers you $10 million for your pre-revenue company, you're probably not hiring a banker, you're just taking the money.
Yeah, probably don't need that much due diligence.
You don't need that much due diligence, you just need a contract to sign.
Yeah. And some of these others that were kind of unsolicited offers, those are for companies with revenues. But what size are the revenue?
Again, that can range. That's a tougher one to answer. I sat down with a friend who runs a venture capital fund, and we were looking at where you're seeing the acquisitions mostly in a lot of these spaces. And you really are seeing them mostly, although not exclusively, in kind of that $10 to $15, $20 million range, where they might be pre-revenue, just starting to sell. They've got a really great core technology. And then a lot of times, you're waiting to the $250 million stage or the $100 million stage at a lower end, depending on the market. But at that point, you're actually not seeing acquirers come in until these companies have proven that they have a business model with a broad range of consumers that continue to use their product or service.
So under 100, it may be somewhat non-proven, yet there's revenue. But once you get to the 250 stage, it has to be scaling on its own.
Yeah, it has to be scaling. And I would even say a lot of times at the 100 million now, it needs to be scaling. So you probably will start seeing some acquisitions at the 100 million. They're getting higher at the 200 million or above. It's that kind of 20 to 100 where people are being a little gun shy and waiting until there's real proven monetization and customers.
So this is fascinating discussion. So in this last year, from all of the ones that you studied from Microsoft and Google, how many were, if you can remember, I'm sorry that I'm putting you on the spot with the numbers, if you can remember how many were in the 100 million to 250 or under 100 and maybe over 250?
I have no idea. I actually haven't studied those numbers.
Okay, it would be interesting to know.
If you look at the Disneys of the world and you're seeing kind of their acquisitions of Playdoms, those are hundreds and hundreds of millions of dollars. Even when they did Club Penguin years ago, that again was a couple $100 million size acquisition. For a company like Disney or Cisco that bought Juniper that bought Ankina earlier this year, they bought that for somewhere around $100 million. Really, a company below that isn't going to make a big difference in their numbers. So there's got to be some kind of core compelling reason for them to buy that specific company. But I haven't actually studied the numbers that specific.
Because it doesn't hit the bottom line.
It doesn't hit the bottom line at all.
Well, this has been one of the most interesting discussions, and I hope everyone tunes in and also tunes into your panel tomorrow. What time?
Wednesday.
Oh, Wednesday?
Wednesday at 2:15, and I just said everything. I'm going to have to do some more research tonight.
Oh, that's okay. Many more people will see this.
Okay.
So, thank you for sharing.
Thank you very much.
Thank you.